The conference is now being recorded.
Good morning. Welcome to the Spheria Emerging Companies Shareholder Conference. Your hosts today are Matthew Booker and Marcus Burns, Portfolio Managers of the Spheria Asset Management. Go ahead. Thanks, gentlemen.
Thank you and good morning. It's Marcus Burns here, Co-Portfolio Manager from Spheria. I'm joined here by Matthew Booker and also by Company Director from the SEC, Adrian Whittingham. So we'll quickly run through the results for the SEC Limited over the last 7 or 8 months since we IPO'd the company. And we'll talk a little bit about some stocks we currently hold in the portfolio and a little bit of the outlook we're seeing for small company investing over the next 12 months. As you can see on the first slide there, profit for the last 7 months was up $7.1 million, with portfolio performance up 7.7% since we incepted the fund at the beginning of December in 2017. We declared a fully franked dividend of 4 cents, which represents a dividend yield of 2.1% on the current share price as at June 30. Bear in mind that's only for 7 months, obviously, of running the company. If you gross it up for a full 12 months, it would equate to about 5.7 cents, or close to a 3% fully franked dividend yield. And you can see that's a fully imputed credit there with franking credits, obviously making the actual effective gross up yield even higher than that. We're pleased with performance, and Matt will quickly run you through how we achieve those numbers.
Yeah, so if we move to slide 3, you can see a waterfall of the NTA movement over the period to the end of June from inception. So we started at $2. We had good portfolio performance during the period. We kept up with the market in large part. We've also had to provide for tax. We've had significant gains in the portfolio that we've realised. So we own Certex and AWE, which were both taken over, in which we made significant profits on. And so we've had to provide for tax, particularly on those 2 stock positions. We've also borne the expenses of the company during that period. But you can see the actual closing NTA at the end of June is that around that $2.10 mark. At the end of August, we just released, we're around $2.14. I'll just pass back to Marcus to talk about some of the highlights over the period.
Yeah, so on page 4, just to remind you, these figures are as at June 30. Obviously, Matt just touched on the fact that the NTA for today has been released for the end of end of August, sorry. So NTA at the end of June was $2.10. It's kind of interesting the way the nomenclature works, obviously, with pre-tax NTA. The pre-tax NTA of $2.10 includes effectively a franking credit on top of that. So we provide in that NTA the taxes realised, but not yet paid. And so there's actually a franking credit that attaches that NTA. You can see on the bottom right of that presentation there, that page 4, performance of the company versus the benchmark. It's a little bit of apples and oranges here because obviously the company NTA is post-tax, whereas the benchmark is a pre-tax number. We'll come on and talk about the portfolio level performance, which is pre-tax, to compare against the benchmark. And we'll show you that we've over the 7 months to June, the fund kept up with the marketplace. It's basically in line. And since that period of time, the fund at the gross level has actually outperformed the market since we've been running the portfolio, which obviously we're pleased about, considering the market's been on a very strong run over the last 12 months or so. So on page 5, just touch on the performance.
Yeah, so as Marcus pointed out, there is distortion between the portfolio performance and the overall company performance because there is tax and company expenses which we bear. We do focus on the portfolio performance, and in that top table you can see that net of fees, the mandate has performed reasonably well in a pretty speculative market. We're very cash flow focused in what we do. We're very valuation focused, so it hasn't really been our type of market. But despite that, we've generated some pretty good absolute returns in the fund, which we're very proud of. Obviously, if you move down to the NTA performance, you get that distortion from the tax payable and the tax accrued, etc. So, you know, what we can control, I think we have controlled pretty well. And, you know, we look forward to good returns going forward because we do think there is a lot of valuation opportunity. So what we'll move into now is just the process, just to give an update on how we think and our philosophies and how we invest. And so Marcus will go through what we look for in companies.
Yeah, thanks, Matt. So on page 6 here, we talk about the stock we've owned for some time, Monadelphous, which many of you will know. It's one of the leading mining services companies in Australia. And we've got two charts on here, just to give you some sense of how we think as investors. The left-hand chart here is one we create automatically in all our models. Basically, all that chart is showing you is that this company is a very good cash flow generating company. Without being too technical, the two lines there just compare the reported earnings, or EBIT, versus the cash flow pre-tax, which is a comparison we do as a team to judge the quality of the earnings of the company. And high quality earnings streams are typically backed up by cash flow. Poor quality earnings streams, in our view, are not backed up by cash flow, and they're the ones we tend to question and typically avoid with our investment process. Monadelphous is a cyclical company, and you can see from that chart on the right the proportion of spending in the country on mining capex as a proportion of GDP. Obviously, it's trailed around that 1.7, 1.8%. That's had an average level over 20 or 30 years. And obviously, the mining boom back in 2012-13 saw that peak at close to 6% and then come off aggressively. And you can see the cash flows of Monadelphous kind of track that. But a couple of years ago, the stock got extremely cheap and fell down to very attractive levels. Because we value stocks on cash flows and use long-term mid-cycle numbers to value companies without being too technical, we found the stock very attractive and bought it. And we still think the stock is one of the best-run businesses in the country, and it makes up a meaningful percentage of the portfolio currently.
Just moving on to Technology One on slide 7. Again, just that simple chart showing cash flow versus profit for a company called Technology One. So Tech One is a fantastic business. It's becoming a SaaS business, and the fact that its revenues are becoming more, or basically less cyclical, and you're seeing structural growth in that business as the revenue is more predictable as it turns to licensing fees. You can see that cash flow and the profit generation of this company from 1998 to 2017. It's a company that most people wouldn't have heard of, but it is, it's beating some of the global players in its market, and it's generating good cash flow, 96% cash conversion over that time. This is the sort of company that we're looking for, but ultimately we want to buy it at the right price. And if you flick over to slide 8, this shows you just, price is what you pay, value is what you get. And EV to EBIT is a good measure for us. If you look at the historic EV to EBIT, so what we're talking about there is the business value versus the earnings of the company over time. You can see historically it's been quite volatile as to what people will pay for this company. If you go back to 2000, which was the dot-com boom, people were willing to pay 30, 40 times earnings for this business. Now, during other periods, people have been paying 5 times earnings for this business. Now, our preference is to buy it as cheap as possible. We are buying a high-quality business here, and it has delivered over time. And what we saw recently was the actual share price depreciated significantly on the back of some accounting changes. But as we know, the cash flow from this business is fantastic. It reconciles to the profit. And what we saw was a window of opportunity in May and June where we managed to buy this company at 15 times cash flow or 15 times profit. Like I said previously, it's been trading up towards 30 times. So we saw a window of opportunity. We took a big position in Technology One. We have been vindicated to date. The stock has rallied significantly since we bought it. We averaged in at $4.46. But we believe that the long-term growth profile of this company is still strong. We still think there's good growth ahead of it. It's not fully penetrated in the markets it operates in, and we've bought it at a very reasonable price.
Exactly, and I think it's a great company. It's in accounting. It's a financial software company. It competes with SAP and Oracle globally, and it's the kind of business we love because it's been taking market share from those two players and domestically. So it typically displaces some of the giants with the domestic product. And what Matt was referring to was the fact that over time this is becoming more of a recurring revenue business and less of a lumpy sales-driven model, which is obviously very appealing. And it's that transition which we think will also add value to the company long term.
Interestingly, if you go to the chart on the right there, you can see that if you bought it during the dot-com era and you paid $1.50 for it in 2000, it actually retraced to about 20 cents. And if you actually look at the earnings profile, which is that shaded area, you can see that the actual earnings grew over time from 2000 to 2017. It's had fantastic growth. But again, if you bought it at the wrong time and you paid the wrong price, the stock actually fell 80% during that period from 2000 down to 2003. So, valuation does matter in our view, and at the moment you're seeing a lot of speculation in the markets. You're seeing people overpay, we think, for cash flow streams. We're very focused on what we're paying. We'd rather pay a lower price for a good company than pay a higher price for a good company.
Definitely.
So just moving forward to slide 9, just HT1. HT1 is a media company. It used to own some New Zealand assets. It also used to own some regional newspapers in Australia. What it owns now is radio stations, so it owns Kiss FM and Classic Hits FM, which most people would know. They're dominant players in that FM space. It also owns a street furniture business called Adshel, which you've probably seen. Whenever you look at bus furniture or train furniture, there's an Adshel emblem usually there. What you've seen recently from this company is it has divested assets, and if you look at the cash flow of this business, the cash flow has actually been strong, so it's a good cash flow converter over time. They've divested those New Zealand assets, they've divested the regional newspapers, and more recently they've sold Adshel, and they sold Adshel for a lot of money. We like the radio assets. They're exhibiting strong growth still. They haven't seen the structural headwinds that other advertising mediums have had. And so what you've got now is a radio asset which is trading at about 6 times cash flow, which is delivering double-digit returns. So this business is growing. It's going to have a great balance sheet post the settlement of the Adshel sale. It's also going to return capital to shareholders through significant dividends and buybacks. And what we find here is a company that's trading on 6 times earnings post all of that.
It's a pretty good example of us looking through the noise, really, Matt, isn't it? I think in terms of our process, radio is fairly disruption-proof, and we'd rather buy a great business like that's been proven to be quite resilient with good cash flow underpinnings at a valuation that's appealing to us and has some downside protection.
We're just looking at one of their competitors yesterday, which is Southern Cross Media, and it's trading on double the multiple that HT1 is trading on.
Virtually the same business.
With virtually the same assets, if not inferior assets to HT1.
Yeah. So that kind of comparable stuff we do as well, which gives us some insight into how we should be investing. Just to conclude, obviously, on page 10, the team goes to great lengths to focus on fundamentals with both our valuations and building portfolios. We try to avoid sectors that have irrational exuberance, and Matt highlighted that before. There are quite a few sectors right now, particularly in the fintech space and vertical, stocks that are called disruptors that we think are well and truly overhyped in the small cap space, and we clearly avoid those areas. We do find periodically that good opportunities abound, so whilst the market's reasonably fully priced, we are still seeing great opportunities periodically coming up. As Matt flagged, things like Technology One, which is a great addition to the portfolio, and earlier in the year we bought Fletcher Building as well on the back of a capital raise, which
we look for diversity as well. So we own a company called Mount Gibson, which probably no one's heard of, and it's an iron ore play, and it's got 65% iron ore quality, high quality iron ore, which is at the top of the range in terms of quality. It's a cash box. It's got 40 cents of cash in it. It's trading at 50 cents. We think the actual project, which they're reopening, Koolan Island, is probably worth another 50 cents. So it's trading a massive discount to valuation at the moment, and we think there's significant upside in this business. Now, the other things that we look at, we own a business called CabCharge, which is in a bit of a turnaround. No one wanted to own it 6 months ago. Now there's plenty of interest in the company. It's started to turn the corner. They're taking back share in the taxi space from other networks. So they're re-penetrating their own taxi space, and they are fighting back against Uber. So there is potential upside there. It's a business that's got $20 million of cash. It punches out $20 to $30 million of cash a year, and again, it's trading pretty cheaply. Now, we also think there's further M&A likely. Private equity is sitting on significant levels of capital. You've seen a lot of global companies venture down into this market. We think you'll see more. So there will be more M&A in our space. It's not that we position for it, but we do look at where companies are strategically positioned, and often what we look for in terms of cash flow and strategic positioning is what global acquirers are looking for as well.
Plus valuation. So you've got still very low interest rates globally. Obviously, you've got pretty low growth rates organically, and obviously the foreign exchange, as the Australian dollar goes down, it makes some of these assets more appealing for foreign investors. So there's quite a few drivers that actually accelerate that process, to Matt's point. So our team is still focusing on cash flow generating businesses with strong balance sheets. We like to avoid highly operationally geared and highly financially geared assets. We think they're incredibly risky. You've been paid to own those assets over the last couple of years, but we think there'll be a time when you actually they become discounted or become very risky in a portfolio. And underpinning everything we do, we think valuations matter long term. And so everything we do is underpinned by valuation support in terms of how we build our portfolios and how we invest your money.
And if there is a downturn, You know, we focus on, philosophically, we're focusing on companies that can self-fund through the downturn. So we're identifying companies that generate cash flow after all capital expenditure, and they don't need to rely on external markets to survive. And again, we also focus on balance sheets. And if you've got a stronger balance sheet, you'll come out the other side of a downturn and you'll come out bigger and stronger. So we think the prospects for the LIC are strong. We're finding good opportunity, and we're finding opportunity at the right price, which is a good thing.
Exactly. And just to finish off on page 11, we've just detailed there the top 10 holdings in the portfolio. That represents circa 44% of the holdings of the fund, of the company, sorry. And we've got, I think the total is probably in the around of high 30s in terms of number of names in that portfolio. So,
and if you had ventured back 12, 24 months ago, some of these companies were trading at astronomical valuation multiples. They've come right back, and they're good companies. They've just been discounted, and we're actually, you know, we're very positive on the outlook for most of these companies. We think that they're going to deliver good growth, they're going to deliver good cash flow, they've got good balance sheets, and it does give us a very diverse portfolio just to navigate, which could, you know, potentially a risky market going forward.
Yeah.
And look, before we move to questions, this is Adrian Whittingham. I just thought I would also touch on the fact that we did release as the guys mentioned, we did release the August NTA this morning at $2.14. We do recognise the company is trading at a discount. We are highly motivated to ensure that we can work with shareholders in that regard. So our aim is to move towards a more regular release of the NTA. We believe that will be or should be supportive of the share price, and also increasing investor engagement, that be it more access, transparency of the investment team, and more release of insights and content moving forward. So, you know, I can assure you we do recognise that it is trading at around about a 6% discount at this stage, and that we will be moving forward to address that.
Okay. Could we now open up for any Q&A, please?
Thank you very much. If anybody would like to ask a question, *1 on your phone now, and you'll be placed in the queue. So *1 if you'd like to ask a question. Thank you. Our first question is from Ben Stiles. Go ahead. Thanks, Ben.
Thanks, guys. Yeah, just wondering what percentage of the portfolio, if any, is made up of microcap stocks?
Ben, look, that's a good question. Thank you. Look, it depends how you define microcap. We define it as sub 500 million market cap, give or take, and it would be around about 35% currently. That will vary over time, but that's approximately the exposure right now.
Yeah, we're finding quite a bit of opportunity in the microcap space. Yeah. It has been left behind in the current market environment. People have been pursuing some of the bigger, smaller caps, where, you know, there's been a lot of alpha generation for managers, so the WiseTechs, the Altiums, etc. And the microcap space has really lagged that, so we are finding some opportunity there.
Oh, great, thanks.
Okay, thank you. Our next question is from Luke Tasgrain. Go ahead, thanks, Luke.
Thanks, guys. I noticed Platinum's the top 5 holding for the company. Does the team still have conviction in the stock, considering it's had a rougher time as of late?
Yeah, it's a company that you know, it's got 27 odd billion under management. They've got $300 million of cash and listed companies in the balance sheet, so it's well capitalised, and obviously it's got a fairly predictable cash flow stream going forward. There is volatility in its end markets, and they have been caught in the Asian markets, particularly China, where there has been a downturn in that share market. What we've seen in recent weeks is actually the performance has picked up. They've seen some outperformance come out of China, and we believe there'll be mean reversion over time. So the US market, which has been on a real tear, will probably underperform going forward, and that will play right into the hands of Platinum, who are obviously more exposed to Asia. So we think the prospects are still good. Obviously the balance sheet and the cash flow streams look very good to us. It's on a yield, I think, of 6% fully franked, so it's paying a very good franked yield, and we think as the fund grows, the earnings will grow.
Wonderful, thank you.
Thank you. Our next question is from Robbie Zong. Go ahead, thank you.
Hi guys. Afterpay, I guess, has been having a very good run in terms of share price. I guess, what's your view in terms of a company in relation to, I guess, how you guys see the investable universe?
Look, thanks, Robbie. It's Marcus here. Look, Afterpay has been an incredible story for other founders and any investors who were lucky enough to buy the stock early on. We struggle with the company for a couple of reasons. Chiefly because it doesn't generate any free cash flow, and as you probably gathered from the presentation, that's one of the key things we focus on for investing. We like companies that actually generate earnings and cash, and therefore have a proven business model before we'll look to invest in those things. And Afterpay has just gone through break even in terms of a reported earnings number, but the cash flow is still very large and negative. So it's not exactly a payments company, it's much more of a finance style company. Interestingly, if you backed out all the late fees that they charge their customers, business would make no money. So look, it's in our view, it's done very well from a share price point of view. From a business point of view, I think frankly it's actually unproven. So we don't actually own that stock in the portfolio. We've done other stocks in finance and tech that actually make more sense to us, like technology.
And there is regulatory risk with the business model. Currently, it's not regulated under APRA's guidance or ASX guidance, and that may change going forward. And if there is greater regulation and greater scrutiny of what they do, it's probably a negative for the business. But they have done a great job. Hats off to them. They've really become embedded in the market and the investor or the consumer psyche. So it's just the valuation and the funding requirements of the business kind of miff us a bit.
Yeah, I mean, and there is a good parallel with a company in England called Wonga, which was an online, it's not exactly the same as Afterpay, it's an online lending business. It's a short-term, very high interest rate lending business that was growing like Billy-O a couple of years ago in the UK, got to a notionally £1 billion valuation. It was regulated against, and the stock is now effectively insolvent. I'm not saying it'll be exactly the same as Afterpay, but if it got regulated, it would be under dramatic growth. It would definitely impinge its growth rates. So we don't own the stock for those reasons. Thanks for your question.
Thank you. We don't have any further questions.
Okay, well, look, thanks very much for your call. This call will be recorded on our website, and if you have any questions and you'd like to follow with Matt, myself, or Adrian over time, please feel free to give us a call or send us an email. We're happy to give you transparency, visibility on what we're doing with the LIC. Thank you very much for your time today.